Welcome, my name is Vishal Tekshanani. Today I'm speaking to the Chief Investment Officer of Magellan Financial Group, Hamish Douglass. Hamish, it's always great to talk to you. How are you?
I'm well, how are you?
I'm good, thanks Hamish. So lots of ground to cover today, and we've also got some questions from our audience on Twitter.
Terrific.
That I'll weave in through our interview. But let's kick off with a survey that Investment Trends did, which showed that online investors, nearly 60% of online investors, the number one thing they're worried about is tension between the world's major economies, so the US, China trade spat. Tell us about where your views at regarding the situation.
Well, first of all, I'd say the reason people are most worried about this is because this is a thing that's in the news all the time.
Yep.
So it's not surprising in a survey that would be the thing that people are most worried about. I would actually say it's the second thing people should be most worried about. I'd actually say interest rates is probably the thing people should most be worried about because there's a lot going on in that interest rate complex at the moment. But in terms of what's going on between China and the United States, underpinning all of this is a very deep, long-term strategic issue of a power struggle for geopolitical and technology supremacy in the world. And that tension is going to go well beyond President Trump being in the White House, as in it's going to go on for at least a decade, we would say. So this issue isn't going to disappear. The issue for short-term volatility, we have to ask ourselves a question, is this current trade dispute going to be put into a truce?
Yep.
Are they going to have some form of agreement to effectively stop the current hostilities? And what I would say to you is, I do not know the answer to that question. And the reason I don't know the answer to that question is because I believe that is largely a domestic political question for Trump. And the reason it's a political question is I believe it's in Trump's interest to have an ongoing fight with China leading into the 2020 presidential elections. So he can demonstrate to his base of voters that he's fighting for jobs and he is tough on China. I think he's also going to be running a tough on immigration line as well. So settling this dispute and saying it's all over may not be in his political interest, because the opposition parties could claim, well, that was not a tough deal and he's being soft on China. So keeping the dispute going into 2020 is in the interest, but also keeping the economy going is in the president's interest.
Yep.
So it's very interesting why we're seeing so much volatility at the moment is because the president ups the ante on the dispute of being tough on China, but when the stock market falls,
He reels back.
He reels back because the stock market is a barometer of the economic performance, and typically you only win elections with a strong economy. So we've got this tension, and therefore I think we're going to see ongoing volatility. I think if we get a major step down in markets, it's more likely we're going to get a truce here. But if we get markets just bobbling on like they're at the moment, up 2% one day, 3%, up 2%, this sort of seesaw effect, I wouldn't be surprised to see this carried on through 2020. But ultimately, I don't know what's in the president's head. I don't think anyone else knows what's in the president's head. But you can see politically where the options are.
Okay, so on your point about seesaws, so we can expect this to continue?
This sort of daily volatility, investors should expect that to continue, but I wouldn't overreact to the ups and downs of what we're seeing at the moment.
Okay, so speaking of overreaction, the Dow fell 800 points overnight. We had this inverted yield curve effect today, and that's one of our questions from our audience on Twitter. What does that mean?
Well, often an inverted yield curve has signalled there may be a recession coming up, that the markets are expecting rates to be cut because an economic downturn is happening. So that would be a traditional interpretation of an inverted yield curve. That means the long end, like 10-year bond yields, are lower than the short end, like 2-year bond yields. And therefore people are expecting the Federal Reserve to cut interest rates because the economy is slowing. I think the expectation that the Federal Reserve is going to further cut interest rates is the correct expectation that we're going to get because of all this uncertainty and the trade disputes and lower growth and this data we're starting to see out of Europe and out of China. I think we're going to get further cuts in interest rates, and the long-term bonds are already anticipating that to happen. That's a very interesting question. I don't believe that it necessarily reflects the United States is about to go into a recession.
Right. Please explain.
Well, if you look at the United States at the moment, the financial system's in a very, very strong position. We've got unemployment at very, very low levels. We've got growth that isn't overheating. And you've got interest rates being cut. So you've got stimulus coming into the economy when unemployment's strong and the economy isn't overheating. We haven't got high inflation in the economy, so they don't have to slam on the brakes here, nor do I see signs that there's going to be a financial crisis. If this trade dispute got seriously worse, yes, then I would say the probabilities of a recession are going up. But normally recessions follow some triggering event that happens here, and I just don't see that at the moment. I see a slowdown with interest rates coming down further.
Okay, so let's talk about interest rates, which, as you mentioned, has a much more significant effect on markets. We're finding it hard to explain to investors as you mentioned, the gravity effect of interest rates on stock prices. Help investors understand, how do these two link up together? When interest rates move up and down, what does that mean for stock prices and valuations in layman's terms?
Yeah, in a very high level, and why Warren Buffett refers to interest rates as the gravity of markets, is because when interest rates are high, stock prices are normally lower, and when interest rates are low, stock prices are normally higher. And that is the dilemma, that as interest rates are headed down to zero, what should be people factoring in? What is a fair price to pay, or what is a cheap price to pay for equities in the market or any other asset when interest rates, we've got over $15 trillion worth of bonds in the world that have now got negative interest rates attached to them. That is absolutely mind-blowing that's happened. And that's why I'm saying this is a much bigger issue than Trump tweeting about China. Right. At the moment. So you're saying 60% people are worried about China. We think a lot more around interest rates and why interest rates, where they may settle over the long term, and what are the fundamental drivers behind interest rates, because we have to put something in our financial models to make a judgment of whether an investment is good value or not.
So does that mean if interest rates keep falling, expect to pay more for the companies that you're holding or you want to buy in
Well,
the markets?
really what's happened since the beginning of this year, and we were holding a lot of cash, around 20% cash in both our core strategies, our global equity fund and also our high conviction strategy, and we have reduced our cash from the beginning of this year when the Federal Reserve stopped tightening interest rates. When they stopped tightening interest rates, we said the interest rate in the next cycle is coming down, and therefore assets can be valued more highly by markets. And so we decided it was better to invest some of our cash than hold the cash. That's turned out to be a correct decision in over 6 months. We'll see over the next 12 and 18 months around that. But absolutely, asset prices have gone up as interest rates have come down.
Okay. So that answers the question about what you're doing in your portfolio. You've reduced your cash holdings to 8%. Talk to us about some stock ideas. So one growth and one defensive. Perhaps Microsoft has now become the biggest position in your global strategy. And something you've been buying recently is Louis Vuitton Moet Hennessy. Do you want to share your thesis behind these companies?
Well, let's start at Microsoft, because Microsoft has actually been quite a long-term investment. We bought it back in 2014, and we actually paid around $28 a share for Microsoft, and it's approximately, depending which day you look at the moment, around $130 a share. So we're up 3 or 4 times our money since 2014, plus dividends. We've received that, and yet it is still our largest investment in our high conviction strategy and our global equity fund. So why do we have the highest investment in something that's gone up so much? And when you look at Microsoft, it's got some very large franchises. It's got the Windows operating system that Microsoft was based off, where most PCs in the world and a lot of servers in the world run programs that are written in Windows. It's then got the Office franchise, which is the biggest productivity software in the world. So people think when they're using Excel spreadsheets, or they're using Word, or they're using Outlook, they're all part of the Office franchise, and they're building a very large platform for cloud computing called Azure, which is, the world is moving its computer infrastructure away from having it in offices like ours and into very large data centres. And Microsoft has 58 massive data centres around the world, and there are 3 big players outside of China. One is Amazon, one is Microsoft, and the third one is now Google. And if you look at their cloud business, Microsoft is really a play on computing moving to the cloud. So this is a cloud play 1/3 of Microsoft's revenue now comes out of their cloud businesses. Actually out of its Office business that's in the cloud called Office 365, which is a subscription model where you access that software via subscription to their cloud databases and it's all updated. They've got some other productivity software called Dynamics. Then they've got software that enables servers that serve the cloud in data centers, and now they've got this huge platform called Azure, $40 billion a year. That is currently growing at over 40% per annum, and their Azure platform is growing at around 70% per year. So the reason is the whole of Microsoft is growing at 12% per annum its revenues.
That's quite a fascinating growth rate.
At the moment. So when something is growing at that rate and these very large businesses, which is now 1/3 of the total of Microsoft, is growing at 40% a year, it's why we still see that this runway has got a very long term. This move to the cloud, we're still in very early stages of this move to the cloud. So it's all about the cloud, the play on Microsoft, notwithstanding we've already made 3 or 4 times our money.
Still seeing more.
This is one of the strategically best positioned companies on the planet.
Okay.
And it's interesting, it's the largest company in the world.
Yeah.
So it's not like I've found something under a hidden rock here. It's just we may have a longer duration. And it was a very large company when we bought it in 2014, but where were the rest of the people buying it back in 2014, which was an interesting question. And LVMH is very different. LVMH is actually the world's largest luxury goods company. 60% of its business is in leather goods and fashion goods. But you think, what are they? The 2 big brands are Louis Vuitton and Christian Dior. That business is growing at nearly 20% a year, and it's 60% of Louis Vuitton. And then it's got other businesses like Moet Hennessy. If anyone drinks, they may have heard of a brand called Dom Perignon or Moet. They may have heard of Clicquot, Cloudy Bay in New Zealand. These are all owned, Hennessy Cognac, all owned by Louis Vuitton. They've got a massive retailing business, DFS, which is, if you go into any airports in the world, the duty-free stores, a lot of them are owned by that. And there's a huge cosmetics distribution business called Sephora that's growing very, very strongly. They have watches, they own Tag Heuer in their watches business, plus others, jewellery businesses that they own. And they've recently bought the Orient Express. So incredible. But why are we there in this business? Again, it's growing very strongly. At the moment, the top line's growing at 12% per annum. But why are we there? We're there because of the Chinese consumer. 1/3 of the sales of Louis Vuitton comes from China at the moment. And that affluent consumer class in China is exploding in its scale. It's currently growing at around 30% a year, and our medium-term forecast for the consumption growth of the affluent Chinese consumer is 15% per annum.
Thanks, Hamish. You painted your thesis very well on them, and I think that's really important, right? They're the market leaders with structural growth drivers.
Growth is if you want to make real money over time, you need compound returns. You need businesses that have high returns on equity and have structural growth. In a world that is slowing down, it is very, very difficult to find places with true long-term structural growth, and that's what we look for.
And that's a good segue into the next question. So Magellan recently announced its results, and as part of that, the highlight is you're bringing the Magellan High Conviction Trust IPO to the market, and you're putting $20 million of your own personal money in this, is that right?
That's correct.
Okay. Help explain to investors what the structure is, and how is it different from the existing global strategy, which many pundits in the industry actually already consider to be high conviction? 25 stocks in your existing global strategy. This is 15, is that right? Help investors understand the difference between the two strategies.
Well, it's even more concentrated than that. It's actually 8 to 12. So this
8 to 12, okay.
This is our 8 to 12 best investment ideas. And because they're more concentrated, it's going to have more volatility. And it's very important for people to understand that. I call our 25 stock portfolio our bellwether portfolio. You may think it's concentrated. I call it bellwether because we do a lot of things to dampen volatility in that very core product. So I'd call this more of a satellite style investment. We've actually had this running for 6 years as an unlisted trust. And for 6 years, we've run it as an unlisted trust, and it's delivered 16.6% per annum returns, net of all fees. It's actually got an actively currency management in it as well, where our core ones are either hedged or unhedged, largely here. So it is more concentrated. It's focused on our very best investment ideas, but because of that, you could have more volatility. We're obviously aiming through the full cycle, hopefully getting a better return than the main strategy, but with a bit more volatility risk that people would take. It's operated. It's not like it's a new trust. It's been going for 6 years already. It's a trust that I manage with Chris Weldon. It's going to be a closed-end trust on the ASX, and once it's a closed-end, we can do things in our closed-end structures that we can't do in an open-end structure. It's going to pay a 3% per annum dividend yield. It's going to pay that twice yearly. But if people want to reinvest for the growth in the long term, we're going to offer a dividend reinvestment plan at a 5% discount like we do in the Global Trust. Yep. Magellan's going to pay that discount. And a lot of people do like to reinvest, and they like the discounts on that. We had a unit purchase plan in the Global Trust at a 5% discount. It's most likely we'd have further unit purchase plans in this at a discount to net asset value to purchase more units at a discount. Magellan pays that discount. So there are benefits of going into these trust structures compared to our open-ended funds. Actually, for people coming in the IPO, if you're an existing investor in Magellan or the Magellan Global Trust or our current unlisted high conviction fund, we're offering everyone the ability under a priority offer to take up $50,000 worth of units. You could take up $5,000 or 10, up to $50,000, and you'll get a 7.5% bonus issue of units in December. And that bonus issue of units will be paid for by Magellan. So it's kind of a loyalty reward for people. But if you come under just the general public offer, there's a 2.5% bonus offer. So we are going to anyone who comes in under the IPO, we will issue them in December 2.5% of their subscription in additional units paid for by Magellan as a bit of a thank you for supporting the IPO. Part of our sort of partnership sort of culture we want to have in these these funds. But I would encourage people to speak to their financial advisors, read the product disclosure statement. It will have more volatility than our other fund, just because there's 8 to 12 stocks, not 25. So we're holding larger position sizes in this, but they are super high quality companies like Microsoft and Louis Vuitton and Visa and other companies which we've had very long term investments in. Starbucks would be another one that's sitting inside that fund. But what you get in this fund is often investments that you will understand are in our core strategies as well.
Hamish, thank you so much for your time and sharing all those valuable insights for our customers.
A pleasure. Thank you for having me.
No worries. I hope you found that video informative. Now, please remember what we talked about today isn't investment advice. If you're thinking about investing in any of Magellan's products, it's really important that you do your research and please consider seeking financial advice. My name is Vishal Tekshilani and I'll see you next time.